I hope that we are live right now. If we are not, I'll quickly introduce it anyway. Hello, everybody. Welcome back to another crypto live stream. And today, we've got ourselves the FOMC minutes. No, we've actually got ourselves the FOMC meeting happening in about 15 minutes from now. We'll get ourselves the verdict as to what's going to be happening to the United States interest rate. And about 30 minutes afterwards, so we're going to cover both of these in this live stream, we're going to get ourselves Jerome Powell giving us some projections as to what's about to happen to the economy, mostly from a Fed perspective over the next couple of weeks and months. And the most interesting piece that we're all wondering and that we're all watching this for is obviously, are they going to halt it now? Right now, the interest rate, for anybody that's wondering, is at 5.25% with the projections that it's going to be going to 5.5. So an increase of 0.25%. And actually, these numbers are something that is basically unprecedented. The Federal Reserve is widely expected to raise the target range for the funds rate by 25 basis points to 5.5% in July, bringing borrowing costs to the highest level since January of 2001 and resuming the tightening campaign after a pause of last month. And so, as I said, everybody is wondering, that's obviously what that little period right after we get ourselves the results is so important for. Let me actually show it to you guys. If we go over to the calendar, you can actually see we've got ourselves the interest rate decision at hey guys, what time zone are you guys in? Where in the world are you guys watching from right now? I'm not sure which one I should put this at. I always use UTC plus 2, but let me know where you guys were watching from. Anyway, we've got ourselves the Fed interest rate decision itself in about 13 minutes from now. And then, as I said, in about 45 minutes, we've got ourselves the Fed press conference, which usually is the most interesting part about it all. Because are we going to be seeing another pause like before? Are we going to be seeing something significantly scarier? I guess we've yet to see. Anyway, I'm also noticing a lot of you guys are in the chat box right now. That is amazing. Look at how many people we've got. That is wild. Wow, we've already got 250 people in the chat box. I think that might be one of the fastest times we have ever gotten to over 250 people. That is insane. Everybody, if you've not done it yet, make sure you press that like button. Nobody is forcing you, but it would definitely be nice. So make sure you press that button if you've not done it yet. And welcome everybody from all places around the world. We've got Canada, UK. Saw a little fly. Canada, UK, PST in the US, Holland, Lake Norway, we got Pacific, UK, California, Sweden, Norway. Wow, that's pretty diversified. Somebody says sound don't work. Not today, buddy. I know my sound work. You ain't getting me today. Oh, my days. Nobody getting me today for that one. Anyway, let's open these bad boys up. So I'm actually sitting down. There we go. Let's quickly take a look at a couple of things. So first of all, as you guys might know, I got myself a couple of different subscriptions. All right, I told you guys before, I'm buying everything. So I bought a subscription to Barron's, not even logged in right now. I bought a subscription to, what's the other one? Wall Street Journal. You know, I bought it for everything. Because I was thinking about it. Like, I'm a news reporter almost, right? How come I'm stingy for that $4 a month or whatever that they charge to see whatever articles they've got? So if you ever need an article, I'm your plug, all right? I'll buy it. In the same sense, I think I spend over $1,000 every single month on random ass subscriptions. Glassnode itself, how much is that one? $800 a month or something? Yeah, how often do I use it? Never. But sometimes I like to share stuff about it over on Twitter. It's a little fun fact. Anyway, just meant to put up there that if you guys ever catch me again saying, oh, this article is paid for, and you don't say, Dusty, what's wrong with you? Get the freaking article. This is your thing. Right now, I'm giving you the authority to say that, all right? I got you guys. Every single time there's an article that's, you know, without your means. And sometimes I'm going to give you guys a little tip here. There's this website called 12feet.io. It doesn't sell feet pics. No, it's not about that. It's basically a website where you can sometimes get behind paywalls. Just giving you guys a little alpha right there. It doesn't work for a lot of websites that are too good, but for a lot of others it does. I'm just giving you guys a little heads up right there. If you're ever too stingy, you know, we might have all been there. Anyway, the Fed meeting today, stocks waver, Dow edges higher ahead of the interest rate decision. The FOMC expected to raise rates by a quarter percentage point. Dow seeks the 13th straight rise. Fed Day is here. U.S. Central Bank's interest rate decision is due in a couple of minutes, about 10 minutes from now. And the Fed chair is scheduled to hold a press conference 30 minutes after. The Fed is likely going to raise it by about 0.25%, which is a 22-year high. Investors will watch for clues about whether this is the last hike of the cycle and when policymakers might start cutting rates. And that's why I'm thinking this time around, the decision itself is not the key. It's actually only the meeting afterwards, the discussion points afterwards, where they explain whether or not this is the highest point and we can basically start cutting or staying stable, or if we're going to still continue to go up ever so slightly. Now, the stock indices wobbled as a slew of earnings rolled in. Wednesday's highlights include Facebook parents Meta, Chipotle, and Mattel. Stocks were mixed. S&P and tech-heavy NASDAQ were lower. The Dow, which is seeking its 13th straight daily gain, was about flat. U.S. bonds gained. Oil gave back some gains. The PacWest stock jumped, and Boeing took off, which I think is a little baseline to put up right there. Let's see here if we've got anything new. No, it's just a link to the Fed meeting, which is happening in about 35 minutes, 40 minutes or so. Let's see. I also had something interesting. A lot of you guys were asking, are we going to drop or are we going to go up from here? The only thing I can actually show you guys is that on the current, I guess, couple of hours, we've got ourselves a little bit of a bearish flag. Not looking too amazing. Not going to lie to you guys. It's not looking too awesome on the short term. And as I've shown to you guys as well, right now, the move with the FOMC, everybody's expecting the exact same thing. The consensus is in, right? Everybody's expecting it's going to be a 0.25 increase, if not staying stable, most likely a 0.25 increase. So probably nothing too crazy going to happen on that front, as right now it's just like full-on consensus, right? 3.5% that deviates from this thought. Very often it's a little bit lower of a probability. It's more like an 80-20. Then again, over the next couple of months, I told you guys another reason this one is so important is because right now we've got a summer stop. It goes from the 26th of July all the way to the 20th of September before we get our next decision. And right now the consensus is that it's going to basically stay flat, no more increase. But if Jerome Powell says something crazy, that might change. We might actually get ourselves yet another increase. Somebody says, do the roar. Have I missed something? Is there a new roar that I'm missing out upon? Not too sure exactly what you mean with that. Anyway, on a different field in terms of our economics, one thing we've also been watching, let me quickly see if I can find it, is what Bearable Bull said. Perhaps right now we're a little bit closer to a top than might meet the eye, partially, for example, because of this. Bearable said, I've always stated this. Once the stock ban bill gets passed and politicians are not allowed to own stocks, that will mark the exact top of the stock market. Fed officials were banned at the previous top. Politicians will use this bill as the excuse to sell the top as well. Corruption and greed never lose. And then he refers to the idea that a couple, I guess a year and a half ago or so, February 25th or so, marks basically a local top for the Dow Jones. What happened on that day? Well, around that day, around that week basically, around the top, right before things started deteriorating again, supposedly, the Fed approved rules banning its officials from trading stocks, bonds, and also crypto. And he's saying now that perhaps, that local top that we saw throughout that week, which, we definitely saw a little bit of a downtrend within that little period. You might say, oh, it's not too much. Oh, yeah, that's the Dow Jones for you. We don't see crazy corrections all too often. Even in 2020, where everything moved so crazy much down, it didn't go down that much. It's about 33% or so. It's significant, but not that crazy. And I'd say here we also went from about 36 or so to how much? About 29. So it's a pretty big pivotal move downwards, which, again, can definitely be pulled back to perhaps some shady stuff that happened over there. It's definitely not too crazy to imagine that. Again, what's happening right now? U.S. senators introduce a bill to ban the president, VP, and Congress members from owning and trading stocks, which perhaps, if passed or goes through, could mark yet another top. A lot of people have been pointing out to that. So will we get the news at about 5 minutes from now or 35 minutes? Let me reiterate. 5 minutes from now, you'll get the official interest rate decision. The only problem is everybody's expecting the same thing. And so the only thing we can point out here is what we're seeing in Bitcoin's chart, for example. Okay, we're seeing a little bit of a bearish pattern. All right, on the short term, this does not look too beautiful, but that's about it because the expectation is already set in. So we're not expecting anything too crazy to happen purely following this interest rate decision, depending on what it is. If it's a 0.25% increase, that's the expectation. If it's 0% increase, so basically stable, that could probably move the markets a significant bunch because that was against the expectation. Now, what is also potentially against the expectation is whatever comes out 30 minutes afterwards. So we've got two trigger points, and the second trigger point is a little bit of a longer one, as it's about an interview and then a little talk from Jerome Powell for roughly 30 minutes. It depends a little bit on the Q&A section, 30 to 45 minutes, sometimes around those numbers, where they basically... He goes on to explain policy. He goes on to explain how they're seeing the economy. He goes on to explain how he sees the job market, etc., and their projections for the near future. And on the sidelines, we also see a couple of questions which usually are useless. They're the most trivial questions ever, and often they're just for the reporters that like to write a story down, but not necessarily in terms of our trade, not necessarily in terms of our general outlook. It don't matter too much. It's mostly for people that really like to know the innards and innards of the economy. But we've already talked about it, just how crazy of a situation that we're in. And I still believe, for the most part, that it's all manipulated anyway. So I don't care too much about the innards and innards. But yeah, so we got two pieces of news, right? Two different points. Also, on a side note, a lot of you guys are saying, so crypto news. We actually are getting a lot of crypto news in the background right now. There's actually a fun little video I want to also show you, if hopefully I can do that right now. Still got about 2 minutes left. So, here was a funny one. A lot of you guys, hopefully you're not offended, all right? How many of you guys are bullish on XRP, just for fun? Because if you're not a problem, but this is what I imagine guys thinking XRP is still a security are into. They just like to get kicked in the freaking nuts time and time again, you know? They like pain, they like suffering, and I guess they like some things that are a little bit wrong, huh? And nothing wrong with that. I mean, if this is what you're into, hey, all props to you, brother, to each their own, but whenever I think of Gary Gensler and stuff like that, I kind of think of people like this. Again, not to hurt your craft if that's you. But that's what I'm thinking, all right? Hey, can't judge me for thinking like that. And I guess we're going to have to watch this in about 10 minutes from now. It's an interesting opening piece here. But this is basically what's going on for the last couple of hours. The Financial Committee is talking about crypto. Everybody's talking about crypto right now as we speak. And this guy also had something funny to say.
Very innovative. We are told that cryptocurrency is very innovative. Look at the incredible financial innovation of Enron and WorldCom, and reflect on the fact that I don't believe that Satoshi Nakamoto was innovative. We are told...
That's interesting. Satoshi that was not innovative, huh? That's a peculiar one. Never heard that one before. But sure. Paul Griffin said, what do you reckon is going to happen to crypto next hour, up or down? Again, if something happens, the most likely probability for the very short term is actually downwards. That's what it's looking like right now, over on the very short term, right? Because of the pattern that we're seeing. But that's about it. To explain to you, can I quickly, give me a second, let me pull it up for you here. Wait a minute. We're going to have to watch that a little bit later, as right now we've got ourselves about a minute left, and so I'm going to just have to watch this very closely. Sometimes on my phone it's a little bit quicker as well, so I'm just going to be there on the phone, and I'm also going to open up the chart here on the side. For you guys, it's going to be a little bit annoying. You're going to only see one of them. Let's just go for the chart, huh? Let's just go for the 1 minute chart and see exactly what's happening. There we go. This is a 1 minute chart for Bitcoin. Just watching exactly what it's doing. It's Bitfinex, not the most liquid of exchanges, I presume, but hey, it'll definitely do the job. We can perhaps get a Binance going. There we go. And here's the 1 minute chart. We've got ourselves the decision. And it is 5.5. So we got the normal increase that everybody expected. Pop! We're popping, we're going! Zoom in! Not too much, actually. But we are on the up and up. Ever so slightly. Why is this happening? Honestly, this is just normal market economics. It's not too crazy. I don't think the price should move upwards too much from a decision like this. And you can actually see what we're witnessing now is something that's like the least volatile in a while. Very often, whenever the interest rate decision comes out, you see a massive move like 1.5 or some percent. The movement that we saw here was roughly 0.5, and it's already retraced. You can see there's a ton of volume as people are speculating, but yeah, that's about it. Nothing too crazy. The decision was expected. I thought before that it could be pretty nice for crypto over a little bit of a longer term, but it depends on the decision that comes out. Bitcoin did look bearish, though, as I described to you guys a little bit earlier. Like on the short term, I wanted to grab for you guys this is annoying how they changed trading view a little bit. I wanted to show you guys this little pattern, but I wanted to also show you the definition of it. Let me, let's just like a bearish flag, just to show you what it looks like. Here we go. This is usually just what it looks like, right? You get a little bit of a downwards move, which we have seen. Then you trade upwards ever so slightly, which we are seeing right now. And then it breaks out towards the downside, perhaps towards some of the range of the uptrend. Because again, I still, as of this point, believe that we are in an uptrend, even though on the short term things are not looking too amazing. Yeah, those are just my thoughts. Right now, how are we doing? Well, we're being volatile, like always, with the meeting. And I'm going to be honest with you, right? You can never predict this too accurately. And what I'm talking about here is where the initial move is going to be, up or down. Like, very often, this is just a little bit of a type of game where it goes the minute that it happens. If you see a very contrarian decision, usually it's more negative. If you see a very expected decision, usually it's more positive. But right now, again, from two sides. On the most fundamental side, there's nothing really keeping cryptocurrencies down, right? I mean, we got ourselves higher and higher interest rate. And from a logical perspective, a fundamental perspective, crypto should be moving up because the worse the economy does in every field, the more necessary this new store of value comes to replace the entire financial system, et cetera, et cetera, et cetera. So the higher the crypto should go. But as we've seen with inflation, the worse the stock market does, and perhaps the worse inflation does, even though in theory it should be nice for cryptos, very often it actually results in a bad negative result. And so from that perspective, it's also really hard to estimate. From a TA perspective, this looked as if again, it's still actually playing, but it looks as if we are going to see more downside on the short term. But on the short term, what we're seeing right now is there was the most significant candle here was a red one in terms of volume, but we're actually still remaining relatively neutral, which in my own opinion means this was an absolute non-event. We absolutely learned nothing, and we're going to have to learn it from the next couple of minutes here. And again, if you guys are interested, the most interesting result is going to be from the meeting in about 24 minutes, where they speak about exactly what's going on. Let me actually quickly tweet what exactly happened. Interest rate increased to 5.5%. There we go. All right, we've tweeted it out. And everybody, if you're watching this right now, make sure that you press that like button. Right now, what we're seeing is a 22-year high for the interest rate, which is pretty significant. I'm not going to lie to you. And we've got a couple of cool videos here to kill your time because we are going to wait 24 minutes, 25 minutes or so until we see the meeting. And that meeting is the most deciding factor. Right now, over on the short term, cryptos really didn't move too much. I'm not going to lie to you. It was actually pretty boring. I expected a little bit more of a buzz, a little bit more of a result. Oh no, are we moving upwards? Ever so slightly, I guess we are. Ever so slightly, I guess we are. But not too much if you compare it to where we were just like about an hour ago or so, right? So yeah, nothing too crazy, nothing too special. Just quite yet, but maybe, just maybe, we're moving up. You guys are saying XRP nearly 70 cents? Yeah. Well, actually, we are already above 70 cents. XRP is actually, ever since the decision came out, moved up. It's up about 1.16% now over the past couple of minutes. So that one is actually doing too well. But we've also not seen any volume on XRP that we did actually see on Bitcoin. On Bitcoin, you can see how much the volume increased as the decision came out, which means people are actively trading it. XRP, not so much as of this point. But Bitcoin seems to actually be moving upwards, guys. That is very nice. Let's take a look at the S&P. Let's just look at the SPY, I guess. Let's take a look. Let's do this one. Okay, so that one, I guess, also saw some similar Bitcoin. Now, I guess it's a little bit different. This one moved ever so slightly more upwards with some interesting momentum throughout this first candle. I think we even have second. This is too awful, right? We're not going to watch the second chart. This is a new form of ADSC. The second chart, guys. Let's take a good look at this, huh? See how every second is looking like. This one does showcase, though, the moment that the result came in. You see, this is why it's always so interesting. The moment that the result came in, the stock market, at least the S&P, moved down a pretty big penny before actually coming back up. Bitcoin, it's too volatile to properly point out. Let's quickly see here. On the second, let's just quickly check, just for fun. On the second, actually moved up significantly, so exactly contrarian to the stock market before moving right back down. Peculiar. But right now, on the short term, we are moving up ever so slightly, so that is nice to see. I wanted to say I got some videos to entertain y'alls for the meantime right here. Let me quickly put this back in. So, okay, we dropped again on Bitcoin. Let me just quickly show you a couple of little videos that were very peculiar, very interesting, at least to me. But before I do that, guys, two things. One, make sure you check out BitGet. A link is down below. It's a crypto exchange I personally use. If you want to trade crypto, this one might be the one for you. Because right now, you've got yourself a spinning wheel, as you can see right there. And it's basically more tasks you do, the more spins you get for free. And you might get yourself a cool prize from it. You might not, but it's worth a try. And on Bybit, you can get yourself an $1,125 XRP trade for absolutely free with a link down below. But on Bybit, you do need to KYC. So if that's not your thing, then don't do it. But that might be your thing, so that's why I'm putting it out there. Yeah. I got so many articles still, but I don't know if we have enough time because I want to show you guys those videos real quick. Another problem I have, this is a very privileged problem, but usually on the side, I have like at least 100 different articles open, 100 different things open at all times. Before, Twitter used to be so easy to see, but now because it's like a black little X, it's become a lot more difficult to notice the difference between a Twitter and or an X nowadays and something like TradingView and whatnot, because they all have the same little logo. At least it's black, right? Black. And before it used to be a very nice, convenient blue, which is a little side note. What is KWC? KYC is know your customer, which means you have to verify your identity. So if you're anywhere in the world, you can't just trade. You need to, be in a country that allows for it, or at least be able to verify your identity in a country. All right, let us find exactly what I was looking for. It's become a little bit more difficult, but here we go. Here's one video. It takes 20. This one we already watched just now. There's an interesting one. So let's quickly watch this video right here.
We're here to take an historic step for American innovation and consumer protection as we undertake the first ever legislative markup for digital assets legislation. The legislation we're considering today is more than a decade in the making. 15 years ago, the Bitcoin white paper was published under the pseudonym Satoshi Nakamoto. The paper envisioned a global financial network built on peer-to-peer permissionless transactions of digital assets using public crypto.
I should give a little note as to what the frick you're watching, by the way. Maybe that's actually smart. Here's the House Financial Services Committee, whose chairman is Patrick McHenry, who's also one of the guys that's pushing right now for crypto regulation in the U.S. And he's also the guy that called out Gary Gensler for being a hypocrite with regards to Ethereum, not being able to answer questions. And if you guys did not press that like button yet, you should definitely think about it. You don't have to, but think about pressing the button because it helps out. And here it says, the chairman, Patrick McHenry, delivers an opening remarks today's historic markup of comprehensive digital asset market structure legislation, where again, they're basically talking right now as we speak about how to go about cryptos over in the U.S. Here's what it looks like. McHenry delivers an opening remark, yada, 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 and there's a little transcript of everything, but they're basically voting on, like we said before, the FIT. I don't even remember what the full-on wording of that is for the 21st Century Act. Today, the House Financial Service Committee, led by Chairman McHenry, is holding a markup of legislation to provide clear rules and for the road of digital assets ecosystem and addresses national security concerns. The FIT for the 21st Century Act is a historic step towards achieving legislative clarity for digital assets, providing robust time-tested consumer protections, and facilitating a regulatory environment that allows this technology to flourish in the U.S. So, and this was his opening. So, yeah.
Cryptographically protected distributed ledger technology. Since then, thousands of builders, innovators, and entrepreneurs have worked to make that vision of a more inclusive financial system a reality. Terms like cryptocurrency, blockchain technology, and the digital asset ecosystem are now part of the everyday lexicon for millions of Americans and people around the world. This is a software revolution and a financial revolution if done correctly. Developers are using blockchain technologies as the building blocks to create the next generation of decentralized internet technology, also known as Web3, which will give individual users more ownership over their data, transactions, and finances. For more than a century, America has been the global leader in technology innovation, invention, and adoption. The ideas turned into innovative technology by American ingenuity have been central to human progress, and digital assets are no different. As other jurisdictions like the UK, the EU, Singapore, and Australia have moved forward with clear regulatory frameworks for digital assets, the United States is at risk of falling behind. We intend to change that today. This committee is taking that first step to fix that problem. I remind my colleagues that joint stock companies were once an innovation that some claimed were only used to facilitate fraud. It took decades to figure out how to properly regulate these, which were predecessors of the modern-day LLCs and equity stock ownership forms that we have. Just as joint stock companies were revolutionized how companies are owned, digital assets and their underlying blockchain technology hold the same promise to revolutionize ownership in the digital economy. Modern American banking law also developed over generations, from Lincoln's National Currency Act to the Interstate Banking and Branching Efficiency Act of the 1990s, and the evolutions that still occur today. We're taking similar actions today by bringing these relatively new innovations into the regulatory perimeter. Our comprehensive digital asset market structure bill recognizes a key issue. Digital assets that are not inherently securities may be offered as a part of an investment contract, but that does not make them necessarily securities. To clarify how the Supreme Court's Howey test applies to digital assets, our bill focuses on two key issues: decentralization and functionality. That is the crux of the Fit for the 21st Century Act, the pairing of those two factors. This legislation was developed not in a vacuum. It is the result of years of bipartisan efforts and numerous hearings, from the bipartisan hearings on Facebook's now defunct Libra project to our bipartisan investigation into the collapse of FTX, to the record 6 digital asset hearings we've held this Congress alone. This includes our unprecedented collaboration with the House.
Somebody asked, are we live? Yes, we're live. Just so you know. We're just watching a video from a little bit earlier. That was pretty interesting, as we are waiting for Jerome Powell to start his speech in about 15 minutes from now. So that's the rundown. And yes, the interest rate decision was already given. The interest rate increased by 0.25%. Just so you guys know, it went to 5.5. I'm not sure if it shows in here just quite yet, from 5.25. So that's the little rundown for you. You can see right there, little increase, 5.25 to 5.5%. All right, so hopefully that was clear. Now, good luck finding where I was watching that video. Of course, huh? Thank you. Where was it now? You see, this is what you got sometimes when you've got a million things open. Here we go.
House Agriculture Committee as well. Our bill also responds directly to the calls from this administration, the Biden administration, for Congress to act through the reports issued under the President Biden's executive order and from the President's Working Group on Financial Markets. And finally, it's important to note that this legislation includes the robust consumer protections that members on both sides of the aisle have called for. At its core, this bill ensures everyday investors are not left with less protections than institutional investors. Additionally, at today's markup, we'll consider Majority Whip Tom Emmer's Blockchain Regulatory Certainty Act, and we will also consider several bipartisan bills to protect our national security, including Mr. Nunn's Financial Technology Protection Act, Subcommittee Chair Lukemeier's Stop Fentanyl Money Laundering Act, Ranking Members Waters' No Russian Agriculture Act, and Mr. Lynch and Nunn's Exposing China's Support for the Taliban Act. I look forward to a robust debate today and taking the first step to provide much-needed legal clarity and certainty for the digital asset ecosystem.
Anyway, so that was an interesting opening, right, from a little bit earlier. Right now in the U.S., they're talking a lot about crypto regulation. I'd say the middle ground for everything is, by the way, Ripple. If you don't believe me when I say that, oh boy, are you in for a little surprise, huh? Because I'd say it's everywhere. It's just well known right now that it's the center of everything. There was another fun video, though, before I move on, that I think you guys should also enjoy.
Yes, it is true the United States also makes money by printing money. That benefit goes to the American people when we provide more services or when we tax them less. And the intent of the billionaire bros in crypto is to appropriate for themselves that literal money-making machine.
And I'm not sure if I'm in a different field here, but please, everybody in the chat box right now, let me know. Is this really him speaking, or is somebody dubbing this over? I mean, if you this is a U.S. congressman, right? Did he just say that, or is that just somebody being a troll and Watcher Guru being wrong? And it's just not. Because I've had this a couple different times right now that Mr. Sherman, who has, by the way, been really against crypto for a long time, has some very outspoken remarks. And I'm never sure if this is just me being stupid, because it can't be him, or let's listen to it again. Just.
Yes, it is true the United States also makes money by printing money. That benefit goes to the American people when we provide more services or when we tax them less. And the intent of the billionaire bros in crypto is to appropriate for themselves that literal money-making machine. Yet,
I'm going to assume it's really him, huh? And, yeah, he's an outspoken fella, and an interesting one at that. John said, there lies the problem. Sherman equates printing money with earning money. He literally believes we could print $10 trillion today, and it would be good for the people of America. Not America as a country, perhaps that would be, but for the people in the country, especially the non-rich folk, just the normal everyday folk. It's an interesting assumption to make, especially from his position, but that's sometimes what they say, right? That you're in a position where you lose touch with reality. And that's kind of like what's going on for him. Falcon says, has Fed hike results been said yet? Actually, yes. The hike result is we went from 5.25 to 5.5%, so an increase of 25 basis points or 0.25%. However, the results for the next couple of months, the projections are out in about 10 minutes from now, which is the speech that we're all watching for. Let me just quickly see. I'm just checking some stuff. There's another thing I wanted to show you. Oh, here was another one. Yeah. Senator Cynthia Lummis said the Ripple decision has reinforced the need for Congress to create a regulatory structure for crypto assets. Lummis-Gillibrand is the comprehensive bipartisan bill that protects consumers while allowing the industry to continue to drive the innovation our economy needs. It's just interesting to me how right now they're really starting to mention Ripple with regards to this. Don't you guys think it's quite peculiar as well that they've gone from being fully ignoring it in every way, shape, or form, being fully against the idea of being involved, to literally stating the case right now? I don't know. I just feel good about it. I just feel... I almost slipped. That would not have been good. I almost feel like there's just something that's been cooking up for a little while here that might be blowing up anytime soon. But maybe it's just my overzealousness, overexcitement. Maybe nothing happening just quite yet. Huber's not really a fan of her, I presume. I mean, many of these guys are all fake, right? They're all just words, but they're not really full of substance. Let's see what's in my likes section here. I got a couple of cool other things, I guess. There are currently gaps between the jurisdiction of the SEC and CFTC that leave consumers at risk. This new bill that we just referred to, that we just saw the opening speech for, closes those gaps to prevent further uncertainty in digital asset markets, ensure consumer protection, and allow for this technology to flourish in the U.S. Because I also made a short about it. Let me quickly show that to you. First, a little water break. If you're not drinking water yet, right now, get yourself some water, my bros. That's juicy right there. All right? And like I always say, make sure you get yourself enough water as well. Just next to the desk here. Let me show you. I should put it right here, because the rest is like it's about 1.5 meters, but it's like annoying to carry. You need to get yourself some water when you're recording these things, But even if you're watching them, get yourself properly hydrated. Let's grab another one. Here we go. Is that Evian? Of course. Enough water to reunite. Okay, let's not. That's nice. Whew. Anyway, we've got about 8 minutes left before Jerome Powell is going to start speaking, which is interesting. Dusty's contributing to pollution. I guess, yeah, maybe I should get glass. You're right. I didn't have glass in the store. Anyway, I just want to quickly come back to this video. Guys, why am I laughing so much? When I think of... Okay, maybe that's so inappropriate. Maybe I shouldn't show it, but I don't give a shit. It's funny as shit. Oh, I just think of Gary Gensler being so wrong every single time, and this is what he into, Oh, my day. Sorry. I had a good laugh at that. I want you guys to realize that it was too funny to me to not show you guys a couple of times. All right? What's interesting as well. So, John Reed Stark, I'm not sure if you guys know him, another guy at the SEC, ex-SEC, I believe. I'm not sure he's still there. He was an interesting fellow. Mostly from the perspective that I've actually been in discussions with him a couple of different times. As you might know, I've been around the space for a little bit. And so I've actually had discussions with many ex-SEC members, many congressmen or senators. I'm not so sure which of those. Honestly, I forget what the freaking difference is in the U.S. with all these different terminologies. You have all these different ranks, all these different committees and stuff. Makes a brother confused, all right? But... over time, I've had a couple of good discussions, and one of the guys, the only person I think I've never gotten a single agreement with ever, is Mr. John Reed Stark, which is funny. So here is a little video from John Dean, and we don't have enough time to watch it, I think, for right now. We actually do. So we're going to watch this. It's about 4 minutes. In today's Crypto Law Livecast, John responded to the unnamed securities lawyers telling Charles that Therez's decision was crazy and won't hold up an appeal. Unnamed, there are too many securities lawyers to name who think Therez's decision is nutty, but here's one. And he links Cointelegraph. Let's quickly open that up. Let me quickly get to it, see if there's nothing crazy. There's not. It's from last week, Mr. John Reed Stark. And John says, Charlie, I'm familiar with John Reed Stark, and he and I have always been respectful to one another, but he's invited any time to talk about the merits of Therez's decision with me. He was wrong before the decision, and he's wrong about it now, although I'd much rather debate someone who brought the case. A career Wall Street guy and securities lawyer versus a Marine deep down, who you'd bet on, brother. All right. I'm sorry, having two classes of investors in XRP is maybe one of the dumbest presidents ever created. I'm not says XRP as a security. But the dual class notion will only lead to more confusion. All right. Peculiar. I think he's trying to say we've got the institutional part and then the retail part. Bill, another lawyer, said, seriously, Charlie, John Reed Stark, he is so virulently anti-crypto. I thought he stepped out of the movie 28 Days. I suggest his views are not even representative of SEC and ex-SEC attorneys. All right, let's quickly give this a little
people want me to attack Charlie because of his position stuff. I'm not going to do that, but I'm going to, because Charlie said that he was talking to security lawyers, right? This is in his article where he says that he's spoken to SEC folks who brought the case. And he said he was talking to these securities lawyers, and not a security lawyer that he talked to believed that the judge would be affirmed on appeal. And so my challenge isn't to Charlie, it's to those lawyers. How about you come out of the shadows? Come not off the record, but on the record. How about you do that? How about you come on to crypto law, right? Quit hiding behind a shield of off the record and come talk. I'll meet you anywhere, any place, anytime, as long as it's live TV where it can't be edited. And we'll have the debate and we'll have the discussion. You want to call Judge Torres's decision crazy, bizarre? Let's talk about it. We know you won't, right? Because I got news for the world out there. When you get picked to be the SEC chairman, when you get picked to be the director of corporation and finance, it's not because you're the most experienced securities lawyer in the world. It's because you got political connections, right? When Trump picked Clayton, it was because of Clayton's connections, period. He was Mr. Wall Street. Rolling Stone magazine called Clayton the most conflicted SEC chair in American history. Gary Gensler's not a lawyer. How come he's the chair? Is it because he knows securities law so well?
And that was actually one thing that was brought to my attention that I didn't fully know. I thought, and I was really convinced about this, that Gary was proper in economics, but also proper in law. But he is one of the first people on his level that I know of now that is not really a lawyer in any way, shape, or form or field, right? Where that's not his specialty. I mean, even at MIT, I thought when he was talking about blockchain, it was also from a law-ish perspective. But really, what did Gensler study? What did he do, or how did he get to his position? And the thing is starting in about 2-3 minutes, yeah. But what did he do? Do any of you guys know what he studied or what was up with him beforehand?
He wouldn't know a security if it bit him in his butt. And we know that. How many times does Gary Gensler get up there and talk about, oh, it's speculation and it has no intrinsic value? Read Howie. Howie tells you that it doesn't have to have intrinsic value. Howie tells you that speculation alone is not enough. Okay, but Gary Gensler was the chief financial officer of Hillary Clinton's campaign. He is heavily connected to the Democratic Party. The Democratic Party won the election. He becomes the chair. Got nothing to do with experience, got nothing to do with knowledge of the law. In fact, why did Hinman become director of chair? He got picked by Clayton. He's on video saying, I got the job because Jay Clayton called me. My good friend Jay called me and said, will you be director of corporation finance? Let me show you how much these so-called experienced securities lawyers know. Let's go to the Hinman deposition that was taken in this case. Okay, look at this question. Let me make sure I understand your testimony. This is a Ripple lawyer talking. Your understanding as you sit here today is that it's not necessary to satisfy all of the elements set out in the Howey test. Is that correct? In order to find a contract scheme or transaction, is an investment contract under the securities laws? That's the question. This is the answer. Bill Hinman says, my personal view is that you don't have to satisfy every single prong. And there are examples of that. Okay, so there is the director of corporation and finance.
About a minute until it starts. I've already got it open.
If he was correct that you didn't have to satisfy all of the Howey factors, then why did Judge Torres say in footnote 13, I'm not even going to get to the other two factors because the third factor is not satisfied. So people out there whispering in people's ears, off the record, living in the shadows. Come on, right? Sunlight is the greatest disinfectant, my friend, and I will provide you with a lot of sunlight. But no, I'm bringing the law and I'm bringing facts to the table.
That was John Dean, everybody. So long story short, I've already got the meeting. There we go. Never mind. Perfect. It's starting. So, yeah, again, understand that whatever he says about policy for the near future is quite important. So I'd say pay closest attention to that. Whatever he says about the interest rate and what they're going to change about it for the near future. And I can put my face here. I can put the chart here. but I think for the most part, the most important thing is just whatever he's talking about. So I guess as it plays, I will also put a chart on the side, or maybe vice versa, where I put this forward, the Bitcoin chart, and then put another little chart on it, perhaps. Might be something we want to do. Perhaps I should just go for the... Oh, my camera went out. Let's see.
Good afternoon.
Let's start with just the meeting for now.
My
then I'll
colleagues and
change
I
it
remain
perhaps.
squarely focused on our
on.
dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run.
That's what he always says, by the way.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
That was garbage.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading. But we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. And we'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index. And lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
By the way, make sure you press that like button, everybody, if you've not done it yet.
Thank
Got nothing to
Thanks
lose.
for taking our questions, Chair
Let's get to
Powell.
500 likes.
Obviously, you upgraded the language around growth in the statement today. You know, we've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this
What?
summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder from your perspective, if that continues, if we see growth not just stabilizing, but doing, you know, performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Did you ask about Barbie? Was that real? Did you guys
Thanks,
also
Chair
hear
Powell.
that?
Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looked good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to
Important.
What we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations, and as a result, we went ahead and took another step. And that's, you know, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but, you know, we're going to be careful about taking too much signal from a single reading. And, you know, growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, you know, how much of this and how much of that. You know, we'll be looking at everything. And, you know, of course, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, you know, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
That's an interesting stance, though. I didn't expect that to come from him.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising. likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think, core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation repeatedly has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is the growth rates edging down towards and below, heading below zero, which is usually a recession indicator.
So I guess the sluice will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this sluice will say.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah.
If you're not done yet, make sure you press that like button. Let's go.
So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last, in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And not.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on the whole. On a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates?
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view, and I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market. And that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions. And that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through, job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So. In effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt. But people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make, I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it, is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until, all the way back to 2 until 2025 or so.
Damn. Okay. 2025, huh? Oh, yeah, that got a lot of people.
Thank you, Chair Powell.
surprised.
Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Bank of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point, and how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong, aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is a restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control, and we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel, or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long, or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event, the market had assigned a roughly 99% probability to the rate move that you announced today. The decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're, of course, very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So. To continue it, you depending on where you are in the cycle. So there are two independent things, and really the active tool of monetary policy is rates, but you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed-rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in, buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now. Thanks very much.
What a beautiful show, huh? What a beautiful shit show. That's the best I can make of this. Did we learn something? No. Did we learn something today, guys? Did we learn something? Did we learn something? Did we get any new information? Except for that 2025 remark that brought the markets down ever so slightly. I'm not sure he said anything really interesting. I mean, he basically, I think perhaps it's because of the whole 2-month pause thing, but he had such an easy way out every time. He kept saying like, well, we're going to have to see over the next 8 weeks, and our goal is to bring back down inflation, but we're going to have to wait for the numbers to see how we're going to do it. Next meeting, and that was, I guess, perhaps interesting, is that he said they might actually still continue to raise it, which I didn't expect. I thought it would be pretty set on just keeping it still. But again, he measures it off against the movement of inflation over the next couple of weeks. And that's where I said as well, the fact that we have 8 weeks in between now, it's the summer break, so to speak, is making this a little bit more difficult, because perhaps for that reason, all right, people have the vacation, and this one woman came up with the, as you can see, people are going to the Barbie. People go to the movies all the time if it's hyped the frick up and if they can go outside. I'm not sure exactly what she's referring to with her Barbie. Maybe she just wanted to get a viral clip of sorts or something. I'm not so sure. But yeah, when she asked that, I'm thinking as well, like, perhaps they're thinking, okay, how is inflation going to change as the summer rolls in and we got all the vacations around the board? Perhaps they want to use those numbers to not necessarily more accurately fight, but to, skew everything a little bit. It wouldn't be the first time they've ever done that. Let me quickly get back to this one. Anyway, I've just been thinking about it from that perspective as to why would he not give us any hints, any info at all, but just keep everything as vague as humanly possible, right? I mean, I'm not so sure if you guys agree with me here, but I think this was one of the vaguer ones that we've had in a while. We didn't learn much at all. Antoinette Van Niekerk says, they think we stupid. I'd say so. They always think we're stupid. Yeah, I mean, yeah. Everybody, if you're not done it yet, make sure you press that like button if you enjoyed the stream, if you enjoyed the update. This was one of the more useless ones. I'm not going to lie to you. All right. Right now, the price moved frick all. We didn't see any movement in terms of price, if you're asking me. It's definitely not the most exciting, not the most interesting one of sorts at all. You could say we went down, but the two blue lines, by the way, these represent where everything started. So this is where his talk started, and this is where the whole debacle started. The interest rate numbers, etc. You could say we're up ever so slightly. You might say we're up about 1% on XRP. And actually, at peak, XRP did go up about 3.5% or so, all the way towards 72 cents, actually. So you might want to say that it did do pretty well. Bitcoin, actually, I'd say is down. I'm not 1,000% sure on that. Let's see. So this is where everything started for Bitcoin. Yeah, we're also actually up. This minute, we're pumping, guys. Take a look at that. Perhaps right now, because Powell is done speaking, people are excited again. They think, you know what? Get this man out of there and let's get going. Maybe that's exactly what's happening right now. I'm, of course, not too sure, but things are in a strange situation right now. Guys, that was it for this stream, though. Hopefully, you guys all enjoyed it. See you guys again in another one. And as I say always, make sure you put that notification bell on, because what if Powell comes up tomorrow and bam, 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 kills inflation or something like that? Or what, of course, if the SEC comes back on to install another lawsuit on top of our heads? If you're a crypto hodler, you must have the notification bell on. I keep telling you how important it is, because if you don't, you might miss out on something very important. As I always say, you can always press the video and ignore it. Press the video and be like, you know what? I don't care. Sure. But perhaps at some point, you're going to just be like, I don't care about those notifications. And you're going to miss something. You never want to have that. Yeah, and more convincing I cannot do. That's about it. See you guys later. Another one. And as I said before, check out the links down below to Bybit and BitGet if you're wanting to trade crypto. Links for both of those are down below. Those are the exchanges that I personally use. But, of course, you do your own due diligence and your own, I guess, analysis on the matter. But just for fun, for reference, BitGet, you got some cool prizes right now, a couple of cool spin wheel prizes, so check that out. Links down below. Or Bybit, you can claim yourself an $1,125 XRP trade. Link for that is also down below. You'll easily find it. It's just a link down below, the first one and the second one. So, yeah. And as you guys all know, pump it up. You've got to pump it up. Crypto's to the moon, baby. The bull market's already started. Let's go.